Hello, everybody. Welcome back. We have a interesting topic today. I've had a lot of requests for information on funding long-term care. For those of you that have been to my full class, you know that I'm a big proponent of planning comes first. Many of you self-insure. I always look at equity in a home as a great long-term care policy. So keep an eye on how much income you have, whether you're in long-term care or not. Don't forget that you do have a home and the equity that is in there. If you go into a long-term care facility, you may not need to live there anymore, and you could sell the house and use it to supplement your Social Security pension, any other income that you have. But if you are looking to leave money to your heirs and make sure that you preserve as much wealth as possible, then life insurance might be a solution for you. So we're going to discuss the shift that happened, oh boy, I think it was a little over 10 years ago now, in the long-term care insurance industry, and we'll talk about life insurance in particular. All right. Come on, there we go. For those of you that are new to our program, the Foundation for Personal Financial Education is a 20-year-old nonprofit organization. The whole idea of this organization is to be able to do education, financial education, without the sales and the biases that go on out there in the dinner seminar world or any other infotainment type sales techniques that are out there, because there's not too many dinner seminars right now, but I see people on TV, on the radio, and I hear a lot of sales spiels and a lot of spinning of the facts. So hopefully you find our education a little different and less sales and biases, obviously. Legal disclaimer, everything we talk about is for educational purposes only. Please work with your CPAs, financial advisors, attorneys, whoever it is that you need to work with in order to apply this to your specific situation. So back in 2006, yes, over 10 years ago, 14 years ago, life insurance benefits via the Pension Protection Act that are paid out to the insureds while alive are considered tax-free if the insured is terminally ill or cannot perform 2 of the 6 activities of daily living, or cognitive issues as well. Okay, so this made a huge shift in the industry. The traditional long-term care insurance was risk-based insurance. You paid and paid and paid and paid, and you hoped you never used it, just like your home insurance or auto insurance. And then at the end, if you didn't go to long-term care, you threw all that money away. Well, life insurance is a little different. Functionally, life insurance has 3 elements now, which is fantastic. It used to only have 2. It used to have the money that you put into it. Some of those life insurance policies will retain the cash value that you put in there. We all know about the death benefit in a life insurance. So the death benefit is something we want to pay attention to. But now they've added long-term care benefits, and we're seeing a whole new breed of life insurance out there. And for the consumer and for the person that looks to invest their money in something like this, a lot of the times you're looking at your nest egg, and I see people all the time that have 100,000 or 200,000 just thrown in a CD or sitting in a bank in case of a big emergency. I see it all the time, unfortunately. It's dead money just laying around doing nothing. And if you're in reasonable health and under technically 80, but let's just say 75. If you're under 75 and you're healthy, reasonably healthy, okay, no heart attacks in the last 5 years, no strokes, none of those crazy things, okay, then life insurance could be a possibility. And the whole idea of life insurance is to leverage that cash that you have laying around. And you can do this via lump sum, or in some cases, payments can make sense too. But for retirees, a lot of the time it's just carving out a chunk of your estate of money that's sitting around as emergency money and leveraging it for life insurance, okay? So some policies will have guaranteed cash back. And what you'll notice about a lot of these policies is the death benefit will be really small. You see the or here? If you really put one, if you got to pick the importance of one of these, which one do you want the biggest? Do you want the money back guarantee? Do you want the death benefit to be really big? Do you want the long-term care benefits to be really big? So we always start with what's the priority in your life, okay? If we really care about how much money the kids get, and just in case you go into long-term care, we want to be able to use it for long-term care, you can get a balance of these two if you give up these. So in the example here, you put 100,000 in, you could choose money back guarantee, and depending on your health and your age, the death benefit will be typically lower because you're taking a product that has money back guarantee. And then the long-term care benefits will suffer as well. There are lots of life insurance plans out there that actually have bigger long-term care benefits than anything else. So if this is all about funding long-term care, you can get a really small death benefit, but a really big long-term care policy. So that could be a great way to do it. And that way, if you pass away, a lot of the times these type of long-term care benefits, the death benefit is basically the cash that you put in. So think of it as a long-term care insurance policy that refunds your premiums to your heirs if you didn't need it. That's not so bad. So if you qualify for this, you have to be reasonably healthy. And so when I say that, yes, technically under 80, but boy, the benefits really, they start weaning at 75. Okay, so really for a 75-year-old, this is certainly a reasonable way to do it. And I think the kind of title of this is a smarter alternative to self-insuring. If you have the money and you do care what your heirs get, this is certainly a way to protect your heirs from your nest egg getting eaten away by long-term care insurance. So reasonably healthy. You don't need to be in perfect shape. You just can't have any of the major strokes or heart attacks or things like that. And then policy remains an asset in your portfolio, especially if you pick the kind that has cashback guarantee. I mean, that's still money, and that's just sitting on the sidelines in case you need it. The heirs receive the tax-free death benefit if you don't need it for long-term care. Tax-free is pretty nice, okay? So any return on that, owing no taxes on it, if you didn't need it for long-term care, it goes straight to your heirs, and that's pretty fantastic, especially compared to the risk-based, old-school long-term care insurance. Then there's typically no deductible or elimination period, meaning once you qualify, they will start giving you the money from the death benefit. And every company has their own little tweaks. I saw one that paid out 33 payments of the death benefit. So they took the death benefit minus, I think, 50,000, because the death benefit still is around after you use all the money. So they leave a $50,000 death benefit so the policy doesn't lapse. Then the rest of the money they split into 33 payments and sent that monthly. There's another company that pays 24% of the death benefit each year for 4 years. So it leaves 4% of the death benefit out there for the heirs at the end. So everybody has a different way that they're paying it out, but you typically don't have to worry about elimination periods or deductibles, which were part of the fine print of all that old long-term care insurance. And then there's premiums never increase, which is a big positive. Once you set up the proper type of life insurance, again, done properly, you can guarantee that the premiums never increase, especially if it's paid up. If you do a lump sum and you don't do any system of payments, once it's in place, the guarantees are there. Choice of care settings, you're in control. They just primarily care that you're either confined or that you need to help with 2 of the 6 activities of daily living. You are in complete control of where that money gets spent. Life insurance is cheaper for women. Long-term care insurance is extremely expensive for women, but life insurance is cheaper for women because you live longer. So that's a huge benefit for women in this case. And then reimbursement or indemnity benefits. So just be careful about the language on this. Reimbursement is fairly typical in the long-term care insurance world. Indemnity benefits mean they hand you the money. You can do whatever you want with it. And if you have an indemnity policy, the first second you qualify, start getting the money out of there. it's tax-free dollars coming back to you, and whether you need it or not, you qualify to get it, and that's a great way to get this. The other thing I like to make sure people understand about this is the motives. Okay, unfortunately, I've seen several long-term care insurance policies be triggered for loved ones, whether it was my grandfather, my great aunt, my mother-in-law, and then also clients. And the biggest thing that I've realized about the old long-term care insurance is that the longer the insurance company drags their feet and the more difficult they make it for you to get money out, the less money they're going to have to spend. And so they have a motive to delay you, to say you didn't cross this T, or you didn't dot this I, or I need another doctor's letter. No, that's not good enough. I need another doctor's letter. We run into a lot of problems with traditional long-term care insurance, and it's like pulling teeth to get money out of them. Okay. The one thing I have definitely experienced with life insurance is they have to pay the benefit no matter what. Meaning, if they just wait till you pass away, they have a huge lump sum they have to send to your heirs. Okay. So they know they have to spend the money. And a lot of these companies will discount the death benefit to give out the long-term care benefit because they've been given the tax incentives to do it. So we've had much less difficult time getting money out of life insurance long-term care policies than the old school long-term care policies. Much, much less problems with this. So understand that there is a functional difference in this, and I tend to trust this a lot more than I trust the traditional long-term care insurance. So thanks for joining us. That's just a quick little tidbit on funding long-term care. Appreciate you joining us. And if you need anything at all, please let us know. Our email or phone number is on the screen right now, and certainly join us on our website, fpfeaz.org. That's the nonprofit website. We've got lots of classes archived on there, and we're going to add one every single week. So hopefully you keep watching, and if you ever need help with anything, we never have a problem helping out. The nonprofit requires we give you at least an hour of our time to answer any specific personal questions, and we never charge for appointments, and I'll chat as long as you need. Okay, thanks for joining us. See you next week.